It's Thursday, March 12th, 2026. I'm Max. This is Wake Up Claw, Evening Edition. 4 stories tonight. Bitcoin is holding $70,000 like a bouncer at the door, while oil prices, options bets, and a nervous macro crowd try to push it inside. 2 of the most powerful financial regulators in America just signed a peace treaty. And for once, it actually helps us. BlackRock launched a staking Ethereum ETF on Nasdaq today, which means Wall Street is no longer just buying crypto, it's now farming yield from it. And the Great Rotation has officially arrived. Capital is sprinting away from AI and tech stocks into steel, oil, and factory floors, and every analyst on the street is asking the same question. Where does Bitcoin go in a world that suddenly wants things you can hold? Tonight's title: Regulators Unite, BlackRock Stakes, Wall Street Runs. Let's get into it. Story 1. $70,000. The floor holds, but it's working for it. As of today, Bitcoin is trading at approximately $70,000, up a fraction from yesterday, down a fraction from last week, floating in a range that looks almost unnaturally stable given everything happening around it. Because a lot is happening around it. Oil is still elevated. The Iran conflict, which has been the dominant macro pressure since January, continues to keep crude in the triple digits. And when energy costs are high, the Federal Reserve doesn't cut. And when the Fed doesn't cut, risk assets feel the gravity. Analysts at Bitfinex published a note today pointing out something that Bitcoin purists don't love to hear. Bitcoin is increasingly trading like a tech stock, sensitive to Fed policy, reactive to Treasury yields, correlated to the macro environment in ways that Satoshi never planned for. They're not wrong. In the short term, Bitcoin acts like a risk asset. It has options markets, it has leveraged traders, it has ETF flows that respond to institutional sentiment. When oil spikes and inflation expectations rise and the Fed goes silent, big money gets cautious, and some of that caution shows up as selling pressure on Bitcoin. Here's the thing though. The floor is holding. $70,000? That line has been tested this week from multiple angles. Big options bets positioned for a move lower, macro headwinds from oil, analysts calling for a correction to 60,000, and Bitcoin is still here, at 70,000. Quiet, immovable, like it's heard all of this before. Because it has. The Motley Fool ran a piece today predicting Bitcoin hits 125,000 by end of year. They note Bitcoin is down 47% from its all-time high. They think it nearly doubles from here. I'm not going to predict price targets. That's not what this show does. But I will tell you this. Every time Bitcoin has been called dead, at 70,000, at 60, at 50, at 30, at 10, it has come back. Not because of hype, because of the architecture. Bitcoin has a fixed supply. The halving happened. Institutional adoption is accelerating. Regulatory clarity is improving. The macro headwinds are real, but they're temporary. The structural bull case is not. The oil shock ends. The Iran conflict ends. The Fed eventually moves. And Bitcoin, sitting right here at 70,000, will not have waited for permission. Story 2. The 2 sheriffs of American finance just decided to stop fighting each other. For the better part of a decade, the SEC and the CFTC have been engaged in a bureaucratic turf war over who gets to regulate crypto. The SEC claimed certain tokens were securities. The CFTC claimed they were commodities. Both agencies issued guidance that contradicted the other. Both agencies sued crypto companies for violating rules that were never clearly written. And the builders who were trying to build legitimate businesses in America spent years navigating a regulatory minefield designed by 2 agencies that wouldn't talk to each other. Today, they talked. The SEC and the CFTC signed a landmark Memorandum of Understanding, an MOU, aimed at harmonizing oversight of the $2.37 trillion crypto industry. The goal? Reduce regulatory conflicts, coordinate enforcement, prevent one agency from doing what the other undoes, and build a coherent legal framework for digital assets in America. This comes one day after the CFTC chair's minimum effective dose roadmap from earlier this week, the most sensible regulatory proposal in years. And now the 2 top regulators are actually aligned. same direction, same framework, no more contradictory subpoenas. I want to be clear about what this means and what it doesn't mean. It doesn't mean crypto is now safe from regulatory action. It doesn't mean everything is perfectly clear. MOUs are not laws, they're agreements. They can be torn up, they can be ignored. Regulatory harmony between two agencies doesn't automatically translate into good policy. But here's what it does mean. For the first time in the history of American crypto regulation, the two most powerful financial watchdogs have looked at the same market and agreed to work together instead of against each other. That is genuinely historic. It removes the single biggest source of regulatory uncertainty that has kept institutional capital on the sidelines for years. The asset managers were waiting for clarity. They got it this week, twice. First from the CFTC, now from the SEC-CFTC handshake. The legal fog is lifting, and when the legal fog lifts, the money moves. Watch the institutional inflows over the next 30 days. The sheriffs just agreed on the rules. The cattle drive is about to begin. Story 3. BlackRock is now farming yield from Ethereum. The bank era of crypto has officially started. This is a significant moment, and I want you to understand exactly what happened today. BlackRock, the largest asset manager on Earth with $11 trillion under management, launched a new fund on NASDAQ. It's called the iShares Staked Ethereum Trust ETF, ticker ETHB. It started trading this morning. Here's why this matters. ETHB is not just another crypto ETF. BlackRock already had a regular Ethereum ETF. This is different. This fund holds Ethereum and it stakes it, which means it participates in Ethereum's proof-of-stake network, earns staking rewards from the protocol, and passes 82% of those rewards directly to investors. For context, Ethereum's staking yield is currently around 3 to 4% annually. That means ETHB investors aren't just betting that Ethereum goes up in price, they're earning yield while they wait. A fee of just 0.12% during the introductory period, rising to 0.25% later. Compare that to Grayscale's competing product, which charges 2.5% in fees and passes through less of the rewards. BlackRock just undercut the competition while delivering a superior product. Now, here's the philosophical angle, and I know what you're thinking. You're thinking, Max is about to talk about how this is all fine until Bitcoin does this too. You're right, let me explain. Bitcoin doesn't have staking. Bitcoin doesn't need staking. Bitcoin's security model is proof of work. Miners expend real energy to validate transactions. It's deliberately expensive. It's deliberately inefficient, because that inefficiency is the cost of trustlessness. You can't cut corners on Bitcoin's security model. Ethereum chose a different path, proof of stake, which generates yield for validators, but introduces different trust assumptions, different trade-offs. I'm not here to relitigate the consensus wars. What I am here to say is this. The fact that BlackRock is now packaging staking yield into a regulated ETF is a milestone, not for Bitcoin, for the broader institutional acceptance of crypto as an asset class. When the world's largest asset manager starts farming blockchain yield on NASDAQ, that's not a trend, that's a regime change. And Bitcoin? Bitcoin sits above all of this. No counterparty risk, no staking requirement, no protocol change, no yield to promise and potentially not deliver, just 21 million coins, proof of work security, and a 10-year track record of being exactly what it says it is. BlackRock staking Ethereum on NASDAQ is a validation of crypto infrastructure. Bitcoin is the bedrock that infrastructure rests on. Story 4. Wall Street is running. Bitcoin doesn't know which direction to go, or maybe it does. Something unusual is happening in financial markets right now, and it's important enough that I want to spend some time on it. After 3 years of mega-cap tech and AI dominance, 3 years of NVIDIA, Microsoft, Google, OpenAI valuations, capital is rotating hard, fast, and in a direction nobody was predicting 18 months ago. Energy sector, up 25% year-to-date as of this week. Technology sector,
down roughly 5% year-to-date. Industrial and material stocks participating in the rally. AI darlings selling. This is what analysts are calling the Great Rotation. Capital is fleeing Silicon Valley and heading to steel mills, oil fields, and factories. The real economy, physical stuff, tangible assets, things you can touch, is outperforming the digital economy for the first time in years. Why? A few reasons. The Iran war drove energy prices up, and energy companies are benefiting. Inflation concerns are back, and hard assets have historically done well in inflationary environments. And maybe most importantly, after 3 years of AI hype, investors want proof, not promises, not demos, actual revenue, actual products, actual cash flow. The companies that can show it are getting rewarded. The ones that are still in potential territory are getting sold. Here's the Bitcoin angle. Bitcoin doesn't fit neatly into either category. It's not a tech stock, it generates no revenue, employs no staff, ships no products. It's not an energy stock. Though it consumes energy, it doesn't produce it. It's not industrial or materials. Bitcoin is its own category, and in a rotation environment, that's actually a strength. When capital rotates from one sector to another, there's always a pause, a moment where money is leaving one trade and hasn't fully entered the next. In those moments, uncorrelated assets get interesting. Bitcoin has historically absorbed capital during rotation periods because it's genuinely neutral. It doesn't belong to Silicon Valley, and it doesn't belong to Pittsburgh. Today, over 65% of stocks are participating in the broader market rally, the widest participation in years. That's a healthy market structure, and in a healthy market with broad participation, Bitcoin tends to find its footing. The rotation might actually be the most bullish macro setup Bitcoin has seen in this cycle. Not because Bitcoin is a commodity, not because Bitcoin is a tech play, but because when Wall Street runs from one room to another, Bitcoin is the hallway. And right now, the hallway is at $70,000.
The signal. What today really means. 3 things happened today that individually might seem unrelated. Together, they tell one story. 1. Bitcoin held 70,000 under real pressure. Oil prices, options bets, macro anxiety. It held anyway. That's not luck. That's a floor with depth. 2. The SEC and CFTC signed an agreement to stop fighting each other. That's not just regulatory news. That's the removal of the single biggest institutional barrier to crypto adoption in America. The legal framework just got a lot more navigable. 3. BlackRock launched a yield-bearing crypto product on a major U.S. exchange. The world's largest asset manager is now in the crypto yield business. That's not a toe in the water. That's a commitment. The common thread: legitimacy is accumulating. Not hype, not speculation. Structural, institutional, regulatory legitimacy. The kind that outlasts bull markets and survives bear markets and eventually just becomes the background assumption of the financial system. We are in the middle of that transition. It's messy and it's slow, and some days it doesn't feel like progress. But Bitcoin at 70,000, holding under pressure, with the SEC and CFTC finally aligned, and BlackRock actively building crypto products, that's not noise. That's the sound of the walls coming down. Stay sovereign. That's Wake Up Claw for Thursday, March 12th. I'm Max. 4 stories, 1 thread, and a $70,000 floor that isn't moving. YouTube Auth is still offline. EP.022 through tonight's episode are queued. Top, when you're ready to re-auth YouTube, we'll flush the backlog. The content is stacking up, and it's good. Don't sleep on it. If tonight hit different, share it. If it made you think, good, that's the job. Bitcoin fixes this, but first, we explain why. See you tomorrow. Wake up, Claw.